Okay, so let's have a look at the last adjustment then for A. Kenny 2021 Sole Trader exam paper. So it says provision should be made for the following. So investment income due and mortgage interest due. Now we've mortgage interest due done as part of our suspense account. So we need to find out how much our investment income due is. And then we also need to provide a provision for bad debts to be 6% of debtors. So we're going to use the new debtors figure we have, calculate 6% of it, see if it's an increase or decrease, and find out what the new provision is. So the first part is then we need to find out our investment income. So we got 3% investment income acquired on the 1st of August. So we've got August, September, October, November, December. So we've got 5/12 to see how much the investment income is for the year. That goes into your add to your operating income. Then we find out, did we pay any investment, did we receive any investment income, and received 2,200. So you're going to find out how much is left to be received, and that's going to go into your balance sheet as a current asset. So we find out here, so investment income 210,000, 3% by 5/12. So 210,000, 3% multiplied by 5/12, because you only have it for 5 months, gives us 2,625. That's how much you're supposed to receive, and that's add to your operating income. So we're supposed to receive 2,625. The question is telling us that we have received 2,200. So what's left to receive then is the difference between the two, which is 425. That goes into your balance sheet as a current asset. We have our drawings then, which was from our interest, or our mortgage interest. 20% of mortgage interest for the year refers to a private sector of the building. So we've that done as part of our suspense account. And the last part then is to provide a provision for bad debts to be adjusted of 6% of debtors. So we have an adjustment done for our debtors. So 70,000 is our debtors figure. We're going to get 6% of that. So our new provision now is 4,000 or 4,200. So we're saying that we're not going to receive 4,200 from our debtors. It's kind of a new provision for bad debts. So we'll have a look in the question to see if we have a provision already, and we do have a provision. So we have bad debt provision of 3,500. So this provision, our old provision is 3,500. Our new provision then is 4,200. So we have an increase of money that we're not going to receive from our bad debts. So that's going to go into our expense in our selling and distribution, and then this 4,200 will take that away from our debtors in our balance sheet. So remember, your provision for bad debts, you find out what the new provision is, then you're going to see, is that new provision an increase or a decrease? If it's an increase, it's an expense and it goes into your profit and loss account. If it's a decrease, it's extra money that we thought we wouldn't get, but we are getting it back, and that's going to go to add in your operating income. So there's two parts to your provision for bad debts. And that's how you answer the last adjustment for A. Kenny.